Today we're going to cover the limitations of financial reports, and we'll just focus on the first three limitations, that being normalised earnings, capitalising expenses, and also the valuing of assets. So there are 6 key limitations as per the syllabus. The second video on this topic will cover timing issues, debt repayments, and also notes to the financial statements. Okay, so the first limitation of financial reports, and when we're talking about financial reports, we're really predominantly focused on the balance sheet, so current and non-current assets versus your current and non-current liabilities, as well as owner's equity. So what are normalised earnings? So normalised earnings refer to earnings being adjusted or changed in financial reports to take into account inflation and to remove one-off factors. And it's generally, the normalising of earnings is generally related to that second part of that point there, to remove one-off factors. The process of normalised earnings and of removing one-time or unusual influences is done to try to show the true earnings of a company. So, for example, if a business sold some land in a particular year, but that sale of land was very unusual for that business, so it was really a one-off item, that sale of land would be removed from the financial statements, so it wouldn't be reflected in the income statement, for example, as part of the overall profitability of that business, because it's not it would not be providing an accurate picture of the performance of that business in that year. If you think about, for example, if you think about Woolworths, if Woolworths sold one of their stores and the land on which that store was operating in a particular year, and they sold it for $300 million, it would not be accurate to include the revenue generated from that sale into their income statement, because that is an activity which does not normally happen. It's a one-off item. So for the purposes of making sure that those financial statements are more accurate, you would normalise it by taking out those financial statements, that financial transaction. Now, how is that actually a limitation? It's a limitation because the businesses can effectively decide if they are going to adjust their earnings and normalise them. So they can effectively say, we're going to include that, even though it's not normal, we will include the $300 million from the sale of that land or business. Or they can say, no, we're going to take it out in an effort to normalise our accounts. So it's really at the discretion of the organisation. Therefore, it becomes quite subjective, and it's really up to, and stakeholders need to be aware of that subjectivity and take that into account. And that you need to really make sure you're clear, you as a stakeholder, you're clear as to whether earnings have been normalised or if those factors have not been taken out. That's assuming that some sort of transaction has occurred that needs to be normalised. Okay, it's an activity for class. The second limitation of financial reports relates to capitalising of expenses. So a company is allowed to capitalise the cost of acquiring a resource or an asset if that particular asset or resource provides the company with a tangible benefit, so a financial benefit, for more than one operating cycle, so for more than a 12-month period. The expenses, for example, involved in acquiring these assets, so if we use property again, the expenses in relation to acquiring that property are added to the balance sheet, and they're regarded as an asset rather than as an expense. So they're added on top of the value of that particular piece of property that was purchased. And that's what the capitalising is. Capitalising is including the expenses associated with the purchase in the overall value of that asset on your balance sheet. So examples would include, if you were purchasing property, the purchase of property would include legal fees. So for example, you might buy a property, or a business might buy a property for $300,000. There are $20,000 in terms of worth of legal fees and $20,000 of stamp duty. On the balance sheet for that asset, they can capitalise that cost, and the balance sheet will reflect a property value of $340,000, not of $300,000. Another example might be research and development costs associated with mining, where undertaking R&D and that leads to the valuation of an asset being greater than the actual physical value of it, because the expenses associated with undertaking that research and development can be capitalised and included on the balance sheet. So again, there's some capitalised expenses are really a part of financial reporting, which can lead to discrepancies and can lead to information not being quite as accurate as potentially it should be, and meaning that people who are looking at those financial statements must make sure that they are looking in detail. The third limitation of financial reports is that of valuing assets. It's difficult to place a value on some assets, and this can create grey areas, and some businesses might look to exploit those grey areas to make their financial statements look better or their financial situation look better than it actually is. Now, the reason assets can be difficult to value is because they change over time. It's quite subjective. Assets might be then held in different marketplaces that have quite different valuations on them. Some assets might depreciate in value. For example, if a business buys a motor vehicle, that will depreciate over time. So what should the value of that motor vehicle be over time? But having said that, it might also appreciate, like property, for example. So these assets are valued at their historic cost, so what they were originally purchased at on the balance sheet, and that's to prevent the manipulation of figures. But the valuation of assets can lead to a lot of confusion, and therefore the valuing of assets is definitely a limitation of financial reports. If you just think about property, if an organisation bought a property and it didn't revalue it every couple of years, and it held that property on its balance sheet at the original purchase value, then that valuation is not accurate because it was 2 years ago or 3 years ago or 4 years ago since it was last valued. And so if you look at that balance sheet would not really paint a true picture of the overall position or financial position of that particular business. That's it for this video.